The world is watching silver hit record highs, but here's what nobody is talking about. It's a fracture, a massive split between the price of silver in New York and the price in China. And that gap is exposing a monumental lie at the heart of the global financial system. What if I told you that the price you see on your screen isn't real? That while traders in New York are celebrating silver at $80, a frantic scramble in China is pushing the real price of physical metal towards $100 an ounce? This isn't just a market trend. This is a seismic event, a signal that the traditional rules of global finance are breaking down right before our eyes. Understanding this silver fracture is critical, because what's happening in this one market could be a blueprint for what's coming next for your money, your investments, and the global economic order. So, what is this fracture? And why is New York's price becoming a dangerous illusion? Let's break it down. It's late 2025 and a phenomenon is shaking the precious metals world to its core. We're calling it the silver fracture. Imagine a bridge connecting two major cities, one in the west and one in the east. For decades, that bridge allowed traffic, in this case, money and metal, to flow freely, keeping prices on both sides almost identical. That bridge was called arbitrage. If silver was cheaper in New York, a trader would buy it there, ship it to Shanghai where it was more expensive, and pocket the difference. This simple act kept global prices in a tight, predictable band. But in December of 2025, that bridge didn't just get a crack, it shattered. The evidence is stark. While global spot prices, largely dictated by the paper markets in New York and London, celebrated incredible new highs, recently touching between $80 and $84 an ounce, the reality on the ground in China tells a completely different story. Reports are flooding in of local prices in key retail and spot markets surging toward $100 per ounce. This isn't just a small premium. This is a chasm, a multi-billion-dollar disconnect that screams one thing. There is a severe, almost desperate, physical shortage. The arbitrage mechanism has failed. The bridge is gone. And the reasons why are sending shockwaves through the entire commodity space. Do you think this is a temporary glitch, or the start of a permanent decoupling between East and West? At the heart of this fracture is China's insatiable, almost terrifying demand for physical silver. This isn't about investors stacking coins in a vault. This is about industry. China's ambition to dominate the future of technology rests on a foundation of silver. Think about it. Solar panels, the backbone of the green energy revolution. They need massive amounts of silver paste. The explosion in electric vehicles, every single one contains silver. And the next frontier, AI infrastructure, data centers, 5G, all of it is critically dependent on silver's unique conductive properties. The numbers are staggering. China now accounts for over half of all global industrial silver demand. It's not just a major player, it is the market. For years, the world supplied this hunger. But now, the pantry is running bare. This simmering shortage just got thrown into a pressure cooker. Beijing, in a move that blindsided the markets, recently announced new silver export licensing requirements, set to take effect on January 1, 2026. This isn't an outright ban, but it's the next best thing. It's a government-stamped signal that every ounce of silver inside China needs to stay inside China. The effect was instantaneous. A domestic scramble of epic proportions erupted. Industrial giants, manufacturers, and even provincial governments are now hoarding every gram of physical metal they can find, terrified of being cut off from future supply. This has supercharged local prices, creating a feedback loop of panic buying, while simultaneously trapping the world's most needed metal within its borders. It's a brilliant strategic move for China, but a devastating blow to global market stability. What would you do if you were a Chinese manufacturer right now? Secure your supply at any cost, or trust that the global market will sort itself out? This brings us to the New York lie. It's a harsh term, but it's one you're hearing more and more from frustrated traders and analysts. It perfectly describes the growing divergence between the COMEX futures price, the paper price set in New York, and the actual, real-world cost to get your hands on physical metal, especially in Asia. The paper market is dominated by contracts, derivatives, and financial instruments that represent silver, but aren't always backed by it, ounce for ounce. For years, this system worked. But when a true physical shortage hits, the paper price becomes a fantasy. The data from December 29, 2025, lays this bare. On that day, a stunning $14 spread opened up. New York's paper market was pricing silver near $75. But in Shanghai, where real metal is being traded for real industrial use, the price was closer to $89. The lie isn't that the COMEX price is fake. The lie is that it represents the true cost of acquiring the physical commodity in the places that need it most. It is a financial abstraction diverging from physical reality. And this isn't just a China story. The strain is visible across the entire global system. The vaults are being emptied. Think of the major silver stockpiles in London and New York as the world's strategic reserve. For years they absorbed deficits, releasing metal to meet demand. But that buffer is vanishing. Between 2022 and late 2025, the London vaults, one of the planet's largest repositories, lost approximately 1/3 of their entire silver stockpile. The metal is flowing out, and it's not coming back. Meanwhile, on the COMEX in New York, inventories just saw their largest 2-week drop in a quarter of a century this past October. The drawdown is accelerating. These aren't just numbers on a spreadsheet. They are physical bars of silver leaving warehouses, and it's happening at a pace we have never seen before. This is what a supply crisis looks like in real time. Now, let's look at where we stand as of December 31, 2025. The market is a whirlwind of volatility. Just this week, silver hit those breathtaking record highs, flirting with $84. But the year is ending with a sharp, brutal flush. Prices have dropped back to around $72 an ounce. Why? Profit-taking. After a spectacular run, large traders are closing their books, cashing in their gains for the year. This is a classic, albeit violent, year-end move. Don't let it fool you. The short-term noise is masking the long-term signal. Despite this last-minute correction, let's be clear. Silver is the undisputed king of commodities in 2025. It is the top-performing major asset of the year, posting a jaw-dropping gain of over 160% year-to-date. It has outperformed gold, oil, copper, everything. This performance wasn't driven by speculation alone. It was driven by a fundamental, undeniable reality, a structural deficit. For 5 consecutive years, the world has demanded more silver than it has been able to mine and recycle. We are eating into our savings, and those savings are running out. So what happens when the calendar flips to 2026? The consensus among analysts who look at the fundamentals is overwhelmingly bullish. The year-end flush is seen as a temporary reprieve, a coiled spring. The structural deficit isn't going away. China's industrial machine will not slow down. Those export restrictions will bite down hard. The path of least resistance for the price seems to be upward. Forecasts that once seemed outlandish, $100 an ounce even higher, are now becoming base case scenarios. The fracture between the paper price and the physical price is expected not just to continue, but to widen. The question on everyone's mind is no longer if silver will hit $100, but when. And what happens to the global financial system when it does? This isn't just about a metal. This is about the credibility of Western financial markets. For decades, New York and London have been the undisputed price setters for the world. But what happens when the world's largest consumer simply says, "No, your price is not my price"? This is a challenge to the entire architecture of global trade. The silver fracture is a test case. If the price of a critical industrial commodity can be dictated by physical reality in Shanghai, rather than by financial contracts in New York, what else can? Currencies? Bonds? Oil? We are witnessing a monumental power shift, from west to east, from paper to physical. So, is the silver fracture the beginning of a much larger financial shift? A warning that the era of paper-dominated markets is coming to an end? Or is this just another temporary dislocation, a media distraction in a volatile market? Share your thoughts below. I'm genuinely curious to see what you think, and I read every single comment.